Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Priya Misra of JPMorgan Asset Management joins us now for more. Priya, good morning.
Morning.
You followed that exchange. What did you make of the explanation coming from the Treasury Secretary?
I think the Treasury Secretary is doing what a Treasury Secretary should do, be a cheerleader for the Treasury market. But, I do think he made very valid points that now what we saw last week, the last few weeks, massive VAR shock. You're seeing 3 sigma, 6 sigma moves across assets. You're seeing correlations break down. Remember that equity dollar correlation that broke down. And so I think investors had to de-lever, de-risk, were there margin calls? So I think there was a lot of technical factors that drove that Treasury sell-off. In the background, though, there is this concern. There's $8 trillion of treasuries held by the rest of the world. Is the end game zero trade deficits? I don't think that's the end game, but concern around foreign demand for treasuries, maybe selling, I think that played into that fear, certainly played into the market, as well as if we're going to get $5 trillion more deficits because of what the House and the Senate are talking about. I think that it became this perfect storm. But I would take a step back and look at fundamentals. Ultimately, the Treasury market is driven by fundamentals. Fundamentals of the hard data has been strong, but we've just had this massive shock to the economy. I think the soft data is telling you that the hard data is likely to weaken. So I do think Treasuries are a good buy. Are we at peak? Hard to say, but we're getting there.
Well, you're getting to the ultimate test. What would happen if the data weakened? Would we buy Treasuries or not? Would the rest of the world allocate capital to the United States, which is important? What concerned people last week wasn't just the sell-off in treasuries. It was what was happening elsewhere in other asset classes. Now, we've seen moments like this one before, where you see forced selling of treasuries, big unwinds of trades, companies, hedge funds in trouble. That's not unique. What was interesting was the persistent dollar weakness alongside that, reinforcing the notion that maybe it was something else. Perhaps it's not, but that's what unnerved people in the past week. How would you reconcile what was going on there?
So I would say that the dollar, has been a highly owned asset, right, for the last few years. Now, I think there's structural components to that, U.S. exceptionalism. Look at where growth is. It is U.S. Companies, profit margins are high. And I think right after the election, there was this idea of re-acceleration. So the dollar got some more of a boost there. Plus, it was supposed to hedge equity risk. It's supposed to hedge risk assets, so I think the dollar, the structural value in the dollar might still be there. Maybe we overdid it. In our view, the dollar still looks overvalued. So I think that's correcting. And then you had this treasury market that was overwhelmed, I think, with all of the selling. There were a lot of supposedly uncorrelated trades. Swap spreads is a supplementary leverage ratio trade. German Bund treasury or that spread was supposed to be about German fiscal stimulus. You had an unwind, whether people got a tap on the shoulder, whether they're just trying to de-risk, whether it's margin calls. I think that overwhelmed. So you did have these two forces coming together, but, it's unnerving. When you see correlations break, when you see this EM market-like market moves, I think that's what reduced conviction levels, and we're seeing headlines every day. So I think uncertainty is high, not just for the economy, but for investors. And I think that's why you didn't see all this buying from domestic investors who might be concerned about the economy.
How much comfort do you get from the potential response function, not just from the Federal Reserve, but also the Treasury Department, with Treasury Secretary Scott Bessent saying that they could buy back off-the-run treasuries?
So I think from market functioning point of view, I think though that buyback operation is useful. The Treasury launched it because the dealer balance sheet, has been constrained as the Treasury market's grown. Can they help market dysfunction? Yes. Can they help? They still have to issue a lot of debt. So I think we're going to be watching, beyond all the tariff news, we're going to be watching what's happening on the tax front. Are we going to get those spending cuts that were sort of promised by Speaker Johnson? If you don't get those spending cuts, the market has to then grapple with a lot more deficit. And maybe that end point of how low rates can go in a recession or in a slowdown is going to be higher because we've got all this fiscal stimulus. I'm a little bit more comforted by the Fed response function. And I think Governor Waller yesterday was crystal clear. Two scenarios, I mean, as clear as he can be, given that there's a lot of uncertainty, but just telling us how are they thinking about tariffs. And he talked about good news cuts and bad news cuts, showing you that asymmetry.
Okay, but here's the issue, and this is something that I haven't heard anybody address. If they were to cut rates in response to potential weakness that hasn't shown up enough yet in the data, wouldn't the long end just yield surge, price drop?
And you could argue maybe some of that happened last year when the Fed cut rates from 5.5, you had that long end selling off. But I would say look at what was happening to hard data at that point. It was actually looking okay. Remember, we were concerned. August, September, we were concerned about the labor market. It stabilized, and that's why the long end sold off. I think, to your point, yes, the Fed has to be concerned. Will they let inflation expectations, those tips break-evens that have been declining, does that reverse? Which is why they can't be preemptive. I think that's what they're telling us. They're trying to explain their reaction function so that first really bad hard data, and maybe it's the labor market, I don't know, maybe it's hiring, maybe it's retail sales. We're going to be looking, not so much as there's this front loading of demand, we're going to be looking at discretionary spending. If I am going out to buy more because I think prices are going to go up, do I cut back on other things? So we're trying to understand how the consumer is responding, how are corporates responding? Are they just not hiring? Or are they actually trying to protect margins and laying off? As that data worsens, I think then the Fed response doesn't unanchor inflation expectations. It actually helps stabilize it because those inflation expectations will crater when the data weakens. And then the Fed can say, no, we got your back. But I think you have to first see it in the data.
This is the communication dilemma of the Federal Reserve. Fed Chair Jay Powell can't go around talking like Governor Waller can. First and foremost, you have to pledge to anchor inflation expectations, to Priya's point. Then if you get the hit to growth and inflation expectations roll over, you can lean into the idea you're going to cut interest rates. They can shape the events they anticipate. And that's the big issue for them. You put out an outlook, and it can influence inflation expectations even of themselves. To your point, if Chairman Powell comes out and starts speaking like Governor Waller, what do you think is going to happen? Yeah. Some people would argue exactly what you think is going to happen. Maybe inflation expectations start to creep high because we start to have arguments around this table. Oh, they don't care about inflation expectations. That's the dilemma they're in.
And this is the reason why markets don't believe that they won't step in when there is a problem in the data. And that's the reason why you have the likes of Andrew Hollenhorst over at Citigroup reaffirming his belief in 125 basis points of rate cuts this year.
I'll leave Priya out of this debate because you won't want to wade in, but this is the advantage you have being a governor and not the Fed chair. The governor can create some distance between himself and the rest of the committee if, say, he wanted to become the next Fed chair.
Potentially.
In the next year or so.
So, do we trust that or do we trust Fed Chair Powell? This is the dilemma.
Priya, it's good to see you. I'm sure you're welcome being left out of that. Priya Misra at JPMorgan, thank you. Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the programme. The administration, I think, has done a very good job. I think President Trump's done a good job of articulating the problem for a number of years now, going back decades, the remedy to the problem and the execution of that remedy. What's your reaction to that over the past few weeks?
Well, it's been scattershot, Jonathan, frankly, and good morning, both on strategy and execution. But, if there's a consistency in the Trump presidencies, I think what you can see is that what he tends to do is kind of go big, bold, clear, motivational, and then start embroidering off the exceptions and the like. And that's certainly the pattern now. I want to be very clear about the direction we're moving in terms of what we're manufacturing, where we're manufacturing it, how we're doing it. But then we're going to wait to have the industries come back and separate the wheat from the chaff on what's legitimate and what's not. So it is a difficult process for everybody. I understand that, and it's a very difficult process. And at the same time, that's how they operate.
John has asked this question many times. Who are they negotiating with? And yes, they're negotiating with themselves inside the cabinet. They're negotiating with companies. They're negotiating with countries. And they're negotiating with a market. Terry, how does that complicate understanding exactly how to get to the goals that they ultimately have laid out?
I think what they end up doing is they prioritize those overlap, but they're not they're not completely congruent. You negotiate as best you can with the individual countries involved, and again push forward bilaterals. Get your best results, move on, get some future promises as well, move on. The cabinet understands that at the end of the day, the president's the decision maker, and so they fold in around. And as to the rest, these companies, by and large, that we're talking about today are big companies that have, among other things, pretty sophisticated lobbying operations, and they're fully engaged as well. So,
yeah. Last night, Anne-Marie talking to Treasury Secretary Scott Bessent. Scott Bessent had a message. He wanted to talk about the three-legged stool of policy, and that tariffs are one wing of that, one leg of that. And then you had deregulation, and then you had some of the tax relief and what was getting passed through Congress. Those other two legs of the stool have been called into question recently in terms of how big they can be and how much they can offset some of the concerns over the tariffs. Do you have a sense of how that's going?
Well, I have tax cuts at 80% likely to happen in the fourth quarter of calendar 2025, and I think there's a rising possibility that it happens sooner. It's not for nothing that that Trump picks July 4th as the day on the next direction on tariffs, and they'd very much like to goose Congress as fast as they possibly can to get the tax cuts in place for the third quarter as well. So. But I'm optimistic that the Congress gets this done. There's an awful lot of alignment on that. As to the numbers, what the Senate and the House are talking about is something on the order of $5 trillion in tax cuts over 10 years, without a lot of offsetting, without a lot of pay-for offsets. And the reason for that is they've chosen, as I've been talking about for a while, this current policy baseline that allows them to do that. So, what you're going to see is a very big tax cut number coming through, I think, and I think that probably balances or more the tariff shocks.
Terry, you think they go beyond extending existing law?
I think they do in some respects, in part because that's what Trump's wanted. These tax on tips and the salt business, all kinds of things they need to do in order to get votes and get a signature into law. Number one. Number two, they're going to have to change the tax code for a variety of things, including providing additional incentives for reshoring and onshoring manufacturing. So I'd look for all that.
Terry Haines, appreciate the input. Thank you, sir. Terry Haines of Pangaea Policy. Let's get over to Ken Leon of CFRA about that. Ken, welcome to the program. What have we learned about credit quality in America in this banking season?
So I think what Brian Moynihan's going to speak about is his comfort zones, which is really Main Street, the consumer and small business. And what we saw in the release today is that credit risk committees make decisions on the current environment, not the forward environment. So that's credit. Again, the results are more stark in terms of the high volatility, the benefit for trading. Bank stocks never get rewarded in terms of multiple expansions for trading profits, but it shores up the full year. Second quarter is going to be choppy. It's really kind of like the beginning of COVID, where analysts like myself looked to the second half of this year. Is it V-shape or U-shape? We're optimistic. We think the capital markets are going to be open, but it's going to be the second half of this year. And what we're seeing is institutions and fund managers realign their portfolios. And that's good for equity trading.
Will it be a V-shape? Will it be a U-shape? Or will it just be a straight line? Because I don't see a dip right now. I mean, talking about the fact that you're getting healthy credit quality pretty much across the board. That's the message from Bank of America. PNC, a smaller but the biggest regional bank, came out earlier this morning talking the same kind of tone, that frankly provisions for credit losses came in lighter than expected. Does this make you more excited for the forward look for banks?
I don't think the story is credit here. It's way too early. It's really what happens in the capital markets and what is confidence for CEOs for capital raising. So again, the second half of this year, if it's going to be stronger, it's not the worries about credit. It's really going to be what happens in the capital markets. Clearly, if there's going to be any severe recession, then it's game off, and then we can start talking with red lights for credit. CFRA, we look at every metric of every bank on delinquencies, loan loss provisions, and reserve build or reserve reverse. We're just not there yet.
Going forward, can you still get optimistic about the banks if M&A doesn't revive, but you do have credit quality that hangs in there and you have yields that are higher than previously?
So the large banks are formidable. They have, as Jamie says, fortress balance sheets. They are formidable in their industry. And we have never seen an equity market outperform without financials and banks coming along for the ride. We're overweighted in financials. We would say to you from 2007 versus 2025, when you look at the top 10 constituents of the financial sector, banks being a big part of it, they're a little less cyclical. They're more stable. And companies like Goldman Sachs with David Solomon talks about moving to more durable recurring fee revenue, whether it be in asset or wealth management or more principal investments in areas like alternatives. So the banks are very different than when we had this discussion back in 2007 or 8. And again, they're not the problem. So again, we'll see what Scott Bessent sees in the market and advises the president.
Again, there's a difference between existential risk and a recession, though. Do you really think they'd perform well in an economic downturn?
I'm sorry. I think when you look at the economic outlook, again, Goldman yesterday noted that they're now still positive, but it was above 2%, 0.5%. There's also the question on duration and also just a technical definition of recession versus a recession that hurts the consumer. And President Trump will pay attention to that.
Ken, appreciate the update. Thank you, sir. Ken Leon of CFRA. Joining us now, the Republican Governor of Virginia, Glenn Youngkin. Governor Youngkin, good to see you, sir.
Great to be with you. Thanks for having me. It's super to be back in studio with you, so I just appreciate you making time for me.
Well, thanks for dropping by. Let's talk about how exposed you might be to this tariff push. You've got some very large aerospace and defense companies in the state. How are you helping those companies and individuals that might be affected by some of this in the meantime?
John, I think we have to step back first and put the current moment in the tariff evolution in context. From while he was running all the way up until today, President Trump has been really consistent on the elements of his economic plan. First, he's going to use tariffs to reset trade balances. And decades of bad deals, he's talked about it. You've heard these words out of his mouth over and over again. Second of all, he's going to make sure that manufacturing is reshored and that we reinflate or reinvigorate the hollowed out middle class. Third, we're going to reestablish fiscal responsibility in Washington. Fourth, we're going to reestablish energy dominance. And finally, through deregulation, we're going to make it even better to do business in America. And those elements are all in motion at the same time. The trade moment for us and the tariff moment for us is also this 90-day pause, which is giving the opportunity for deals. And every cabinet member has repeated there's 75 countries in motion right now. And I would expect that there will be some significant trade deals struck. I do think that there will be a level of ongoing tariffs. And the 10% number wasn't one picked out of a hat, and they call that the base tariff. But I'm a governor watching, but I do expect that there will be deals cut. And those deals, importantly, will be with some of our largest trading partners, India and Japan and Korea. And so this is what's going to happen over the next many months. And most importantly, I think that will bring some confidence to the market that this reset, which has to happen, and disruption is part of a reset, will open up long-term opportunity. Now, Virginia, we're seeing that long-term opportunity every day, and that's through our economic development pipeline. We've had an incredibly robust 3 years. We've had record investment or commitments from businesses expanding in Virginia, $100 billion in 3 years, by far the largest amount in that time period. We've seen record job growth. Virginia went from bottom third in job growth to top 3, 5, 10 every year in job growth. And that has allowed us to run surplus after surplus after surplus. The net of that is that we have open jobs in Virginia, 250,000 open jobs for folks to take. But on top of that, our economic development pipeline has been as full as it's ever been. And we're seeing businesses, international companies want to come to the United States. We're viewed as the top state in America for business, and they want to come to Virginia. And so that's a really good foundation for us as there is a period of disruption. But I think there's a long-term opportunity, and I think Virginia will really do well.
We can talk about the long-term opportunity in the fuller policy platform. I do just want to keep it on trade just for a moment. On trade, the methodology, it does feel like was pulled from a hat in the last few weeks. And the criticism we hear around this table quite a lot. They will acknowledge the problem, and they will acknowledge that the president has articulated that consistently and well over the period of decades, not just weeks and months. It's the remedy to that problem. At the moment, what we hear from the bank CEOs, from investors, is this economy has drifted into a wait-and-see moment, that they aren't going to make those big capex decisions until they really know the rules of the game, the rules of the road. Do you think we'll know the answer to that within 90 days?
I think we'll see a lot of clarity over the course of the next, now 80 days, I guess, or 82 days.
I'm losing count.
But the net of it is that President Trump was clear. He's continued to be clear that in resetting bad trade deals over the last decades and reestablishing reciprocal trade opportunities, by the way, with nations that are our allies, China's a whole different topic, but with nations that are our allies, we just need fair trade, and we haven't had it. And so, to reset those trade imbalances, you see him do what he does well, which is create space for negotiating. And I think that's exactly what's happening. When the first weekend after April 2nd, you read in every publication that 75 countries had called within a day to start the negotiations, and you've already seen those negotiations, at least reported in rumor. I think this will be this opportunity to take a big step in resetting this.
Hold on a
second. I think that's what the market needs to see.
Part of the problem, I think, and you know this very well, having invested heavily as a co-CEO of Carlyle and been investing in infrastructure, which takes a long time. There's a maturity mismatch between when some of this negotiation is happening, when these tariffs go on, and how long it takes to bring that investment to the United States. There is a lack of clarity about whether those policies will be continued in perpetuity, and it's leading to paralysis at so many companies. What do you tell the companies in your jurisdiction who's come to you and say, how can I plan? How can I hire? How can I invest when this could change, when I don't even understand the parameters we're talking about?
Yeah, I have to disagree with you on the long-term planning, because we're seeing a pipeline of economic investment that has been as full as it's ever been. And these are long-term investments. Fortune 50 companies wanting to build in America and in Virginia, hopefully, if we can recruit them there. And these are long-term investments. And you saw NVIDIA yesterday talk about $500 billion. We've seen most of the big pharmaceutical companies commit to building in the United States. We're seeing technology investments, advanced manufacturing, all in the United States. These are long-term investments. I think the difference in a lot of people's understanding is that during market ups and downs, well, yes, IPOs get postponed. And yes, corporate deals get postponed. But these long-term commitments are actually coming in very large numbers. And that's good for states like Virginia. I mean, listen, we're in the SEC of economic development. I compete every day with Tennessee and North Carolina, South Carolina, Georgia, Florida, Texas. And we've got to compete. And I think that much of that investment will come to this region, and that is a long-term commitment. And so the uncertainty in the near term, yes, I get it, I understand it, but the long-term expectation that America is going to be the best place in the world to invest is clear and real, and that's what we're seeing in our economic development pipeline.
There's also an issue of staffing all of this up and how we do this, when not only is there a maturity mismatch, but also potentially a skills mismatch. And I know that your state has been significantly affected by some of the DOGE cuts, and you've talked about that and how you plan to provide for some of these workers. But how do you reskill people to work for different types of jobs, given that they've worked in a very specific field and there might not be jobs in that field, and what we're trying to build up hasn't been there for a long time?
Well, first you go to work and prepare an education and training ecosystem to do exactly that. And we've been doing this for the last 3 years in Virginia, which is resetting the career paths and the education paths for lots of Virginians with opportunity. And today we have an incredibly high labor participation rate. It's bounced back from lows during the pandemic and the previous administration to near one of the national highs. We have one of the best workforce training programs in America. We were just named for the third year in a row of having the best customized job training program in America. This is what you do. You go to work. I do think that the expectation that there will be job losses, particularly out of the federal government, is real. We haven't seen them yet that much in Virginia. I mean, our first-time claims and unemployment are still at historic lows. But listen, I do think that the federal government's downsizing is necessary. Listen, we're at $37.5 trillion of debt, $2 trillion a year of incremental debt. We can't do that. And so resizing the federal government and recognizing fiscal responsibility is critical to the future of the country is real. What does that mean in a state like Virginia? We have a lot of federal workers. A lot. Now, a disproportionate amount of those are in the defense and in the intelligence and national security area, and we're seeing more money go into those areas. But I still expect that there will be real disruption for some folks in Virginia. My dad lost his job twice when I was growing up, and I've seen this in families my own, and it is really hard. And that's why a pathway to a new career is so important. Because of our economic growth, we have 250,000 open but unfilled jobs in Virginia. And over 100,000 of those require a bachelor's degree. These are good jobs, but they're also jobs that pay well. And so opening up that pathway to folks who find themselves with job loss is really, really important. And so we launched something called Virginia Has Jobs. And it's for folks to get jobs in Virginia from all over the country. But at a time when we're seeing this dislocation from the federal government, it's a real opportunity pathway. 250,000 jobs, pathways for training, coaching, resume writing, but also for making sure folks know how to file for unemployment and keep their health care. This is a pathway that I'm really hoping that people who do have job disruption can find a way to a great career in Virginia, because Virginia has lots and lots of jobs, and people can go to virginiahasjobs.com and actually find one. And that's part of, I think, this movement of really public sector employment to private sector employment. And we've seen it in Virginia. We've had great job growth over the last 3 years. It's led to record surplus after surplus after surplus, which has allowed us to reduce taxes. It's allowed us to invest in education and in law enforcement. And by the way, in economic development and job training. But it's also, I think, changed people's view of long-term in Virginia. We used to have, for 10 years, we had more people move away from the Commonwealth of Virginia than move into from the other 49 states. And last year, we became one of the top importers of talent in America. So this works. And at a time when President Trump, again, is trying to run a very, very full policy agenda, resetting trade, balancing the federal budget, making America dominant again in energy, reshoring manufacturing, and restoring this middle class, which has been eviscerated over the last 20 years, and doing all of that while deregulating to make America even a better place for business. I think we can look at Virginia and say, hey, we've seen at least a little microcosm of that, and it works.
Governor, the stakes are high. I'm pleased you mentioned your experience growing up. You, like me, we were professional dishwashers. You went on to have a fantastic career leading Carlisle, and now you're dedicating yourself to public service. There are now people much younger than us who believe that dream is not available to them, that upward mobility is no longer something available in the United States. And at the moment, as you know, filling stadiums around this country as left-wing people like Congresswoman Ocasio-Cortez, Senator Bernie Sanders. If this administration gets this wrong, we could see a swing in the pendulum all the way to the far left. It's not unthinkable. You can see that taking place. How high are the stakes? What happens if this administration screws it up?
Well, I first and foremost don't believe they will. And therefore, I think what people will see over the course of this administration is the realization of this long-term opportunity. And that's why all of the elements that in play are critical. You know, there are so many people in government who believe there's one policy solution, this magic wand that will fix everything. This is an incredibly complex economic transition model. And that's why having all of the elements in play at one time, while complicating, is critical. because they're each going to contribute for the long-term success. And if you peel out one, energy dominance. Listen, getting energy prices to a place where they're sustainably affordable at the gas pump and in the supply chains, critical. America should basically dominate the world of power and energy. Making sure we have a balanced fiscal moment, not running $2 trillion deficits, critical for the long-term success of America. Reshoring manufacturing, and think about what's happened over the last decades, where we watched critical, very high-paying jobs move around the world away from America and hollow out our middle class. That's the opportunity that has really been missing, because we've seen literally the middle class not participate in the economic growth of America over the past few decades. This is what this opportunity is all about. And I've said many times, I think the number one job we have as Americans is to help this administration be successful. And that success will translate into an even better America than we have today.
We've said it around this table. We hope they are. Just a final question. What's the future of Governor Youngkin? What do you want to do next?
Well, I finish up next January, and I just want to begin by saying this has been the most purposeful moment in my entire professional career, and I've loved it. And I want to make sure this last year is incredibly productive for Virginia. Listen, you only get 4 years in a governor's job in Virginia, and I've got 1 year left, and I got to get 4 years of work done in this year, because we've had a great first 3 years, and I want to get a second term jammed into this last year. But I also recognize that there are a lot of folks who spend all their time planning for their next job. I'm not one of those folks. I'm going to spend 100%, if not 150% of my effort making sure that Virginia continues to thrive. We've got a really important election this year. Our Lieutenant Governor, Winsome Earl-Sears, has been a great partner for me through this entire economic revival in Virginia, and I want to make sure that she gets the baton. I think voters will trust us and trust her and want to elect her the next governor of Virginia, and then we'll decide what I do after I've watched her be inaugurated.
Youngkin Vance, 28.
I'll decide after I'm done in January 2026.
I had to try, Governor. It's good to see you.
I will repeat, though, the most important thing that we need to be doing right now is to be helping this administration be successful. And I think the elements are in place. It is a complicated set of movements in order to reset so many things at one time. But I have great faith that the long-term opportunities really are going to be great. And we're seeing that in companies who are investing all across Virginia and America.
For the good of this country, I think a lot of people agree with you. We hope you're right. Thank you, Governor. I appreciate your time. Thank you, sir. The Virginia Governor, Glenn Youngkin there.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.